Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, Steve Brice here. Today's Tuesday the 11th of August. Welcome to Cut to the Chase. Today I want to talk about gold. Gold has been on an exciting roller coaster ride so far this year. After a euphoric rise in January, at one point it was up over 25%, we then saw it decline. Initially this was expected given it was sharply overbought and there were signs of significant excess. But then the Middle East conflict started, which drove further selling for three reasons. First, it put upward pressure on the US dollar and bond yields, which were significant headwinds for gold. Second, there were hints that margin calls in other asset classes required cash to be raised, and with gold still being up for the year, it was a great place for investors to raise cash and plug these holes. And finally, some central banks sold gold to support their local currencies and even to potentially fund widening fiscal deficits. However, we remain constructive on gold throughout this period. At a strategic level, we have a 5% weight in our portfolios, higher than most of our peers. With gold having outperformed equities over the course of the past 5 years, the weakness from Feb to June notwithstanding, this naturally stood us in good stead. However, we actually like it for its diversification benefits as much as its return potential. With inflation likely to be structurally higher in a world which is deglobalizing and supply chains under constant flux, the fear is that the correlation between equities and bonds will be higher than has historically been the case, reducing the diversification benefits of holding bonds. Now, just to be clear, I don't want to overplay this. We still have a significant allocation to bonds in our portfolios, but it certainly supports a higher allocation to gold than has historically been justified. Meanwhile, the sanctioning of the Russian central bank in 2022, which basically froze Russia's access to most of its foreign currency reserves, has been a major influence on gold's demand and supply dynamics. These sanctions incentivized any central bank in the world that is not totally aligned with the US and Europe to look for alternatives to developed market bonds in their foreign currency reserves. In a world with limited options, gold is one area that central banks have focused on. As mentioned, we did see some central bank selling in March of this year, but it appears that buying has resumed back to pre-conflict levels. And we believe this is a structural force of demand until gold reserves as a percentage of total reserves rises significantly. So after dipping below $4,000 per ounce in June and July, gold seems to have formed a significant base and has risen 8% so far this month and around 11% from its lows. This is despite the recent disappointment regarding a potential US-Iran deal to open the Strait of Hormuz, which has put upward pressure on oil prices and bond yields. Interestingly, the US dollar has remained weak despite this. The US employment report on Friday was weak, which may explain the US dollar's muted reaction to continued Middle East tensions. The Fed is expected to be less hawkish than previously markets had expected. Indeed, in our view, we still do not expect the Fed to hike interest rates. Our view has been that inflation peaked in May, and the lagged effect of higher oil prices is likely to lead to a weaker labour market in H2. And this was reinforced by the employment report on Friday, which showed not only a decline in the number of jobs, but also a significant downward revision to historical job creation numbers. This meant that the 3-month moving average of job creation fell from a previously reported 111,000 in June to 20,000 in July. Obviously, that's a marked deceleration. The next thing to watch out for is inflation data in the US, which will be released on Wednesday evening Asia time. We expect this to reaffirm our outlook for a disinflationary trend and further downward revision to interest rate expectations. Against this backdrop, we remain both tactically and strategically bullish on gold and see any short-term pullbacks as an opportunity to raise allocations towards 5%. Thanks for joining us today, and we look forward to chatting with you again soon. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.